Hello, hello. Hey, everybody. Happy Thursday. Happy Thursday, y'all. Listen, I'm gonna try one more time, okay, on Instagram. We're gonna try this one more time on Instagram. I know I said that last time, but I gotta keep trying because I don't want to not go live on Instagram, so I want to see if it lets me go live or if the notification comes out. So just give me 1 second, y'all. As you come on, though, thank you for everyone that is coming on. Thank you to everyone who's jumping on. I really appreciate y'all, man. Listen, I got it. You probably busy right now. It's a Thursday. You're probably at work. It's early. This isn't our normal time. You're not on your lunch break yet. I got it. So as you're coming on, do me a favor. Put your city, put your state, put your country, okay, that you're tuning in from. Put your city, put your state, put your country. There it goes in. See, it's doing the same thing. I don't understand this. Like, I don't know if because I'm not as active as I used to be on Instagram, because I'm more active on YouTube, but maybe that's why. I'm not sure. Oh well, it's still doing the same thing. I don't know what's going on. But yeah, so it's still doing the same thing. I don't know what's going on. What just happened? Why did they do that? Okay. Anyway, so let's get into it. We're gonna move forward, y'all. Appreciate everybody jumping on here live. For those of you tuning into the replay, do the same thing, y'all. Put your city, put your state, put your country into the chat. I'll be able to come in and reply back to you. Anytime you have any questions, y'all, feel free to ask those questions. Just drop them in the chat. For those watching the replay, you could just put it in the comments, and then I'll come back and I'll reply to your comment. Okay. So again, thank y'all so very much for tuning in, whether you're watching live or the replay. For those of you that are new to this YouTube channel, welcome. And I am so happy that you're here. Y'all prepare to take notes and also apply what you learned today. And then, of course, come on back to get more info to help you to elevate your trading experience. All right. We're rolling into the end of 2024, so I want to make sure everybody is good, set up for success for 2025 trading. So now, for those of you that have been rocking with me for a while, you've been tuning in and everything, you've been watching this series, you watched all 3 parts of this series. Thank you for continuing to support me. I really do appreciate it, because I'm well aware, y'all, that there are multiple people out here, hundreds, thousands of people out here teaching things pertaining to trading, whether that's in the stock market, cryptocurrency market, forex market, doesn't matter. There are a lot of options you have out there, but you're coming here, you're showing up here. So I really do appreciate you. Okay. So who is excited for the discussion today? Who's excited for the discussion today? Drop me in the chat or in the comments if you are ready and excited for part 4 of this series. As a matter of fact, you could do something else too. You can hit the thumbs up for those of you on YouTube. You can hit the like or the heart button for those of you tuning in on Facebook. Okay. You can also subscribe to this channel if you find the information that has been shared thus far has been of value to you and where you are heading. Okay. And then also, if you're not part of the Prosperity Cause community, y'all hit that notification bell so that way you know when I'm going live, because like Sunday, I'll be live again. But if you're not part of the community, you won't get the email, you won't get the text notification. So go ahead, hit that notification bell, right? So that way you are aware of when I'm going live, okay? So that is it. We're going to go into this disclaimer, and then we're going to go into a bit of a introduction and recap, right, into part 3 before we start our series for today, okay, session for today. So remember, y'all, trading and investing in any market can contain substantial risk and is not suited for every individual. Remember, every trader and investor learns and performs differently, so our results will not all be the same. There is a potential for a trader and investor to lose all or more than their initial investment. So due to numerous factors, y'all, this is why I suggest to every person to only invest money that can be lost without jeopardizing their financial security and or lifestyle. I don't need y'all out here homeless because you don't put your life savings into the market. Like, please don't do that. All right. Don't put your retirement fund into the market when you're trading, whether it's forex, stocks, crypto, doesn't matter, y'all. Don't put all of your money that you cannot afford to part with, into the market. Remember, I am not a financial advisor. I'm not a licensed trader. I don't work with the CFTC in any capacity. I am a student, just like most of you are. The only difference is I'm sharing the ups and downs, the things that have not worked for me, but also I'm sharing the things that have worked in hopes that prevents you from experiencing some of those hardships that I experienced in the beginning of my journey, okay? I'm only sharing information for educational purposes, y'all. Okay, so you as a viewer of this channel, you as a viewer of this live stream or the replay, right? I'm expecting you all to do your own research. Take what I share with you, dissect it, make sure you understand it, do your own research, and then apply how you see fit, okay? At the time and in the place that you see fit, all right? Remember, all traders and investors that utilize any strategies discussed on this channel, services and products that may be shown on this channel, will do so at their own risk, y'all. No one's past profits will guarantee you any future results. So we all learn, we all perform differently. So you may make more than me, you may make less than me, you may go in the negative. It all depends on you and your situation, how you think, how you move in the market, okay? So again, y'all, this information is being provided. This information is being provided for educational purposes only. Now, we got that part out the way. For those of you that are new to me, my name is Leona Clark. I'm a wife. I'm a mother. I am a retired Army veteran. I did 20 years active duty in the Army, and I let it go in 2021. I hung up my uniform, and I took them boots off, okay? And I have been blessed to trade in the forex market for the past 5.5, almost 6 years, y'all, 3 of which have been full-time. I became full-time in 2021, all right? Now, with all the ups and downs, you know, that I've experienced while trading over the years, I've been fortunate enough to just connect with hundreds of military members, and I'm talking about in the trading space, military members, parents, college students, even high school students, y'all. And I've been honored to join them on their trading journey. So because of this exposure that honestly began back in like 2020 via a trading company that I was partnered with, in 2023, I created my own trading program that was specifically designed for beginners and those struggling to profit from trading, based off of things that I personally wish I would have known, and the things that I heard multiple people in the same position I was in, heard them talking about they wish they would have known. That's how these trading programs have been developed. So due to those things that I've experienced, like I said in the beginning of my trading journey, I really wanted to take it a step further and share the things that would have sped up my success and had I properly understood it. And that's why, honestly, y'all, I created this series, okay? Because I'm giving you some of that information, a vast majority of that information, for free. So if you've been tuning in, right? If you've been tuning in and have learned something in the first 3 parts of this series, I need y'all to drop the word me, M-E. Drop the word me in the chat. If you have learned something, doesn't have to be a lot. If you have learned something in the past 3 series, okay, past 3 parts of this series, I need you to drop the word me, M-E, in the chat. You can do that too, if you're watching replay. So that is it. That's the introduction. We're going to get into a quick recap of part 3 before we talk about our topic for today, which is risk management. But first, part 3, we covered technical analysis. We went into a bit more detail on technical analysis. We talked about support and resistance first, right? So for those of you that have watched parts 1 through 3, then you know what support and resistance is at this time. And you can actually drop it in the chat. Like, what is support and what is resistance? Write it down. Like, type it. I said right. Type it out. Type it out in the chat right now. Type it out in the chat. What is support and what is resistance? Right? Because remember, y'all, I went on TradingView and I showed you all what it looks like as well. I didn't just tell you what it is. I showed you on the chart what support looks like and what resistance looks like. Okay, so type it out in the chat. Let me see if anybody's typing in the chat, but I'm gonna keep going, y'all, because I got a lot to do today. Today's gonna be a busy day for me, so I'm like, I'm doing my best to, like, get everything done. So support and resistance. This is what we talked about in part 3. Remember, y'all, support is a price level where the price has fallen to, but doesn't go any lower because buyers step in to push it back up. Remember, so price is dropping down, and then at some point, price is like, oh, nope, I've been here before. Now we're going to go back up. Okay, y'all, you would hear traders say support is like the floor. All right. So if people say it hit the floor or we're at the floor, that means support. All right. Everybody got it. And resistance is like the ceiling. Okay. This is where our price level in the market keeps going up, but for some reason it can't go above that price point. So like this is where price is being multiple times, right? And it comes up here and it's like, nope, I can't go, and then it drops down. So this is our ceiling. Okay, so you will hear people that's in the trading space use the term ceiling in relation to resistance. Remember, y'all, this is another note for those that did not tune into part 3. Go back and check out part 3. Okay, you can click the description in this video. Click the link in the description of this video. It has each previous part. Okay, but remember, y'all, this is a really good key, something that I learned to help me with support and resistance. Y'all, when you see 2 or more touches within that same area, right? This gives us an indication that there is a strong support or a strong resistance. So 2 or more touches in that same area, we're looking at a strong support or strong resistance. The more touches, the stronger the support. The more touches, the stronger the resistance. All right. That's a quick recap on that. Now, there were 2 other things that we talked about, which were 2 indicators that you can use. This is not to say that you only use that and don't do any other market analysis. You need to still be able to identify support and resistance. I do a top-down analysis. Like, you could do whatever, but make sure that that works for you and your strategy. You can add a technical indicator like the moving average, which is what we talked about in part 3. Remember, y'all, the moving average, it just gives us as traders a clearer view of whether the market is going up or it's going down or it's consolidating, like it's staying flat. It's going like this, and it could look like this. It could be a wave, but it's not really going up. It's not really going down, okay? The moving average helps us to make a more informed decision. Y'all, honestly, this could be like a confirmation for what your analysis of the market has already told you. Okay. Then the second technical indicator that we discussed was the RSI. That is your relative strength index. If you watch part 3, you know what that means. If you did not watch part 3, go back, check it out. Okay. But the RSI helps us as traders to determine those overbought and oversold conditions. You're going to hear that every single time a person mentions the RSI. I don't know anyone says, yeah, so I'm pulling up the relative strength index and I want to look. No, they say, hey, man, the RSI told me that we looking at overbought, so I'm preparing for the sale. That's how they're going to talk, okay? So overbought, as a refresher, is on average. It can change depending on how you trade using the RSI, because there are some people that have taught me in the past, they use 60 as their overbought area. There are some that have used 80 as their overbought area, but the vast majority on average uses 70. Okay, so above 70 indicates overbought conditions. So this just means that the price may be too high. It's been high for so long, and there is a drop that may happen. Price may push down. Now, for an oversold condition, we look at the number 30. Now, this is an average number, right? Sorry, y'all, about that. But this is an average number, right? The number is 30. There are some people who have used 20. There are some people who have used 40. Again, the more you trade, you're going to find what works for you. But the vast majority on average use 30 as the area to indicate oversold sold conditions. So this just means that price has been too low, or it may be too low, and it's been there for so long that a bounce may occur. So the price may push up. All right, everybody got it. So now remember, y'all, you had some homework, sir. Hey, Diesel. Now my dog want to bark. Diesel D. Stop it. Sit down. Sit down, please. This is real life. So anyway, so you all got some homework. Hopefully you did your homework. If you did your homework, let me know in the chat, okay? And for those of you watching the replay, you can comment too. Let me know if you did your homework, because this was the homework, y'all. I wanted you to practice doing that technical analysis. Remember, you were tasked to use just one major currency pair. If you don't know what a major currency pair is, I need you to go back and tune in to parts 1, 2, and 3, because I went over it each one of those times, each one of those parts, okay? But you were supposed to use one major currency pair from part 2, right, of this series, and continue practicing identifying the trend, right? Anyway, however, you were also to add, like, identifying the support, identifying the resistance levels, and you were to do that on the 4-hour time frame, okay? And use the line chart if you needed it, which I highly encourage you to do. Use the line chart to help you out with identifying those areas of support and resistance. Remember, you can use your demo account if you already have a broker in a forex market. You can use your demo account, or you can use TradingView. Okay, so if you don't have a demo account yet, because you're like, this is your first time hearing about trading, like learning about trading like that, totally got it. We went over TradingView.com. I showed you how to get to each thing. So again, if you didn't watch the previous parts, I need you to go back and watch them, y'all, because I'm not gonna go through it this time around. Okay. On top of that, another part to that homework was for you to apply the simple moving average, because there's two different types of moving averages, but to apply the simple moving average and the RSI, you needed to do that separately on that major currency pair that you selected to see if you could clearly spot the trend, or if the market was moving sideways, like if it was consolidating. And then when you apply the RSI, I was expecting you, because that's what I showed you and encourage you to do, was to use the vertical line, so that way you can see where the market actually hits those overbought and oversold conditions. Okay. And of course, the last part was you were expected to take notes, y'all. You have a trading journal that you should be keeping now to keep track of all of this information, so that way you can make better decisions before you enter a trade in your demo and also in your live broker account. Okay. So who did the homework? Let me know. Let me know who did the homework. I want to see if you did the homework. I don't know why I'm not, like, I'm seeing people on here and I'm not seeing anything. So either y'all are really busy, which I got it, because this is not the normal time. So you may be at work. If you're at work, I got it. Okay. I apologize. Let me just keep going, because y'all might be at work. All right. And sometimes I can't see the comments from Facebook. It's not all the time, but sometimes it's like I go back to Facebook and then I can see the comments. I'm like, that wasn't showing up on StreamYard. So anyway, let's keep it moving. So y'all, today's focus is we're going to have a goal for you to create or update your risk management plan for 2025. Okay, y'all, 2024 is at the end. We have elections next week here in the US, and then you have the holiday season right behind that. You had a holiday season right behind that. So that means that you're just gonna have to, start preparing to slow down your trading or just cease trading altogether, to be honest, because the market is going to move totally different than what it has in the previous 9 to 10 months. Okay. So that's part one of our goal. And then also to help you to establish a thorough risk management plan, so that way you can, make more money easily and consistently in 2025. That's why this is being discussed today. You're getting a whole session only on risk management. So remember, y'all, risk management can either make or break your trading experience. So this is why it is a crucial key to continue success as a trader in any market. All right. So let's get into it. We are talking about risk management. If you are ready to talk about risk management, if you can, if you're not engaged at work, if you're not driving, type ready in the chat. For those of you watching the replay, of course, you know, when you're watching the replay, as long as you're not driving, as long as you're not at work, type ready in the comments. All right. We're going to talk about risk management and why it is so crucial. So I need y'all to just keep this in mind. Even though I'm going to explain and give you a definition of risk management, it's the examples that's going to help you much more. Okay. So risk management is just the process of identifying, assessing, and controlling the amount of risk involved in a trade. Y'all, again, like I said before, this applies to crypto, this applies to the stock market, this applies to Forex. Anything that you're trading, we need to assess that. Okay. Proper risk management is essential to us protecting our capital and staying in the game long term. This is why we have so many people that quit trading, because they have not buckled down and locked in on managing their risk. Because we come in with unrealistic expectations on how fast we should learn this skill, how fast we should make money, and the amount of money we should be making. And especially if you're coming in with small capital, y'all, you can't be going in like, I'm putting a standard on that thing and you got a $500 account. If you're like, I don't know what you mean by standard, Leona, that means you need to go back and watch part 1 of this series. Okay, go back and watch part 1, because I talked about that with lot sizes. All right, so here are some key risk management concepts, components, right? Number 1, you hear me talk about risk to reward ratio a lot. If you tune in to me on Sundays, you're probably like, I'm so sick of hearing Leona talk about this risk to reward ratio. Well, the reason why you're hearing it again probably is because you're not doing it. If you're watching me, more than likely, you are either new to trading or you have not seen consistent profit in the market. And so now you're attempting to figure out, where did I go wrong? What did I not do? What could I do? Okay. So with the risk to reward ratio, we are aiming for a positive risk to reward ratio. This is like a 1 to 2, a 1 to 3, a 1 to 4, a 1 to 5, whatever you can get, more than a 1 to 1. What do you mean by that? I'm going to get to that in a second. But I'm telling y'all, when we aim for a positive risk to reward ratio, it helps us as traders to manage our risk and improve our chances of long-term success. So here's how it works. Because I know you were asking, like, what do you mean by 1 to 2, 1 to 3, 1 to 4? I got you. Okay. So a risk to reward ratio is us defining the risk, meaning like, okay, how much am I willing to lose on a trade? And then how much reward am I expecting to gain from this trade? So I'm going to give y'all an example. I tell every person that day trades with me, your bare minimum should be 1 to 2. Anything higher than a 1 to 2 is great, but your bare minimum is 1 to 2. This means for every $1 you're risking in the market, you're aiming to make 2. Everybody got it? So if the trade goes in your favor, your reward will double the amount you're risking. Why is this important? Because even if you lose half of your trades, the 1-to-1 risk to reward ratio ensures that your wins make up for your losses. Okay, so I'm gonna give you an example. Now, this doesn't apply for a 1 to 2, but I'm gonna give you an example for a, let's say, a risk to reward ratio of 1 to 3. Let's say you win 3 out of 10 trades. The profits from those 3 trades can still outbalance the losses from those seven trades, right? Now, I know you're wondering, like, well, how, Leona, how is that possible? Well, Let me show you. Okay, y'all ready? If you're not driving and you can take some notes, okay, this is a perfect time for you to start taking notes. This is the perfect time. I'm gonna give you a chance to get pen and paper if you didn't get it already. I'm gonna give you a chance if you're not watching me on your phone. Pull up your notepad on your phone. This is the perfect time to take notes. All right, let's get it. So let's say you're using a risk to reward ratio of 1 to 3. Remember, this would mean that for every dollar you're risking, your goal is to make $3 in profit. Got it? 1 for 3. I'm putting $1 in the market. I want to get 3. Got it? So let's say you're like, okay, I'm about to enter this trade and I am going to risk this is what I'm comfortable risking. I'm comfortable with risking $100. That is my cap. I'm not going above $100. Cool. So that means you should be looking for setups in the market that have the potential to give you $300. Y'all, the way you're going to find that out is through calculating the number of pips. Got it? So let's say that these trades you're taking, your stop loss is 10 pips, right? Where your profit area should be at least 30 pips. That's a risk to reward of 1 to 3. That's only part of it. Okay? 1 to 3. Your lot size is going to dictate with that 10 pips that you're only risking $100. So you need to calculate the lot size that is going to grant you the ability to only risk $100 or less. Everybody got it? I told y'all this in parts 2 and 3. So I need y'all to make sure that you're doing that. Calculate what you stand to lose first, and then calculate what you stand to gain. This helps you to prevent from going overboard and now you're losing more or you're risking more than you're comfortable with risking, and now you're having a panic attack. Now you're having a panic attack when the trade is going in the opposite direction. Okay, so risk per trade is $100, right? That's my max. I'm comfortable with that. Cool. But every setup I'm looking for at least 300. So now, out of those 10 trades you take, remember, you win 3, you lose 7. So when you win those 3, each win is going to give you a total of $300. Well, you have 3 times 300. That's $900 in total profit. Does everybody follow? Remember, each trade is what you're looking for winning is 300. So you win 3. 300 times 3 is $900. Got it? I'm pretty sure people are good with at least addition, subtraction, and multiplication. Okay? Division might be a little, we ain't doing algebra over here, y'all. We doing basic arithmetic, as my grandma used to say. We doing basic arithmetic. Okay? We're doing adding, subtracting. We're doing multiplication, and sometimes we do division. That's the max we do, y'all. We don't do anything extra when it comes to trading. All right, so now we got it. So we know with those 3 trades, our profit is $900. Well, you take a lesson with 7 trades. Well, remember, you're only risking $100 per trade anyway. So that means each trade is $100. 100 times 7, because you lost 7 trades, that gives you what? $700. So now our total profit from those 3 excuse me. I've been taking medicine, y'all. It's just still lingering. But total profit from those 3 wins is $900. Total profit or total loss from those 7 lessons in the market is $700. So 900 profit minus 700 in our losses gives us $200 in net profit. Everybody got it? So even though you lost 7 out of 10 trades, the larger reward on your winning trades allows you to end with a $200 profit overall. So let's say that you did that in a week. That means you ended the week with $200 in profit. Okay? So this shows a good risk to reward ratio. This shows how a good risk to reward ratio can make you profitable even if you have more lessons in the market than wins. All right? Everybody follow. Again, y'all, all we're doing is adding, subtracting, multiplication, especially when it comes to risk to reward and whatnot. Adding, subtracting, multiplication. All right? Now, I do want to, we're going to use the same example for a risk to reward of 1 to 2. So if you win 3 out of 10 trades, this is what this is going to look like. We're going to keep the same number, right? With the risk. We're only going to risk 100. Well, a risk to reward of 1 to 2 means what? For every $1, you're standing to gain 2. So that means our reward per winning trade is 200 at a bare minimum. Everybody got it? So if we win 3 trades, remember it's 200 per winning trade. So that's 200 times 3. What's 200 times 3? I'm giving you a second to say it in your head or type it in the chat. Okay? 200 times 3 is 600, y'all. So I need you to write that down. We're doing a risk to reward of 1 to 2. Same scenario, 3 out of 7 trades, 3 out of 10 trades we won. Okay? So now let's calculate the lessons in the market. Excuse me, y'all. So the lessons, we had 7. Well, remember, we're only risking $100. So it's the same scenario as the first one. So that means that's $700 in losses, right? So that means our result, we had $600 in profit, but minus $700 in losses. That means we are in the negative $100. So with a risk reward ratio, if you win only 3 out of 10 trades, you will end up with a $100 loss, showing that this ratio requires a higher winning rate to stay profitable. Y'all got it? If not, let me know before moving on. If you can, y'all, I need y'all, don't lose your job now because you over here like, or don't have an accident because you over here attempting to type. Like, come back to the replay and then put your question in, okay? If you have one, okay? So now, listen, there's going to be a difference for my scalpers out there. Your analysis, emotional intelligence, discipline, and consistency, and doing the right things must be top tier, because you're more than likely like you're not looking at your risk to reward because you're getting in and out of the market. You're getting 10 pips, 15 pips, 20 pips here and there. Like you're not looking for a longer or a bigger amount of pips. You're looking for small amounts and you're in and out. You know what I'm saying? You'll do a few trades in a day and be like, all right, I'm good. And then you're going about your day, right? Now, again, this is not to say that all of y'all aren't looking at risk to reward, but I guarantee you a majority are not. Okay? So, because as a scalper, you want to be in and out of the market in like 15 minutes or less. Some of y'all will probably stretch it to like 30, 45 minutes, and that's max. You are less likely to get a risk to reward of 1 to 2 or even higher in such a short time trading currency pairs in the FOREX market. Now, could you possibly see that with trading indices, cryptocurrency? You know what I'm saying? You probably could. You won't see that with gold. I'm gonna tell you that now because I've been trading gold for a long time. Your risk has to be great. Like your stop loss, honestly, with gold has to be like between 60 and 80 pips. So you scalping gold and you're thinking you're gonna get a 1 to 2, that's not gonna happen. I'm just telling you now. I've done scalping with gold and day trade, and it doesn't work. That scalping, you have to make sure that your stop loss is at least somewhere between 60 and 80 pips. So yeah, you're not going to get, it's not common. Let me rephrase that. It's not common for you to get 120, 160, and 200 pips in a matter of like 5 minutes, 10 minutes. Like, that's not common. Can it happen? Does it happen? Yes, it does, but it's not common. Okay, you're more likely going to day trade, that so that way you can get a risk to reward of 1 to 2. All right, so now for my day traders out there, you will have a little more wiggle room. However, in the example I just gave you, you can't afford to take too many losses with a risk to reward ratio of 1 to 2, because eventually you will end the week or the month at a loss. So y'all, I shared these 2 examples to remind you that risk management will make or break your trading experience. I didn't say that in the beginning of this session just because it sounds good. No, you see it for yourself. This is why it is critical. It is crucial for all traders, no matter the market, to understand risk management thoroughly. So if you just experienced an aha moment, I need you to type it in the chat if you can, and be safe with it and don't lose your job now, okay? That's for my people watching the live. If you're watching a replay, then yes, type it in the chat. Type AHA. AHHA. Aha. Like, okay. You know, like, I got it. All right. Y'all, this is something that I did not understand for the longest time. Hence why I was blowing accounts. But it wasn't until I started journaling, I started watching different trading videos, and then ultimately I adjusted my plan. And I stuck to, at a bare minimum, 1 to 2 risk to reward. Do I want more than that? I absolutely do. I look for those opportunities. But my bare minimum as a day trader is 1 to 2. Now, listen, y'all, if this is helping you so far, okay, if this information, this video is helping you so far, share it. Sharing is caring, y'all. Share it with someone that has been trading for a while and has been struggling to make profit consistently, or someone who has talked to you about trading, like they're curious, they want to get into it, they don't really know where to start. This is a perfect starting point because it's free information and it helps them to see if trading is indeed for them, because this is not for the weak. This isn't for the finicky. This isn't for the people who move with the wind and they're bouncing back and they're indecisive. This is not for you. I'm telling you, save you some money and some heartache, okay? If it's hard for you to make a decision, if you are, more of a follower than a leader, if you're struggling right now financially, like really bad, and you're in massive debt, don't put money into the market you can't afford to part with. Trading may not be for you right now, but you can still listen and learn and practice on TradingView or in a demo account or whatever. Get all the free nuggets that you can until you get your finances in an order to where now you can do it, or when you get yourself mentally prepared to study for real, then you can move forward, okay? All right, so let's get back on track. Let's talk about why risk management is crucial for you as a trader. Number one, it improves consistency, right? By consistently using a positive risk to reward ratio, you don't need to be right all the time. This is something I didn't understand, because I was like, man, I just knew I was right. Yo, I don't have to be right. Even with a lower win rate, which you saw, the larger rewards from winning trades can lead to overall profitability. Y'all, this means that the higher the risk to reward ratio, 1 to 3, 1 to 4, 1 to 5, 1 to 6, right? So on and so forth, the more lessons you can take, you still make money. I remember, and I've shared this with multiple people that's part of my community, right? That's inside the Prosperity Calls community. But I remember watching this video of this gentleman that was trading with FTMO. It's a prop firm, right? And this is about 2 years ago. He had a win percentage of 22%, y'all. Now, I teach people like, hey, aim for 80. Why? Because if you're aiming for 80% and your risk to reward is like 1 to 2 or higher consistently, y'all, there is no reason for you to blow an account. No reason. This gentleman was making money big time with a 22 win percentage. But here's the thing, his risk to reward was like a staggering 1 to 20. Y'all, he showed the dashboard, and I was like, God, no. But here's the key. He was more focused on low risk trades. He wasn't focused on taking a certain number of trades in a day or in a week. Low risk trades was his focus. Which trade gives me the lower risk but stands to give me the biggest reward? That was his focus. So him switching to that way of thinking resulted in him earning over $500,000 in 1 month. Now, here's the thing. I know y'all like, oh my God, see, I can do I need you to slow down. Don't let that number go to your head, because there were a lot of painful experiences that gentleman had to encounter as a trader prior to him getting to that level and understanding. So I need you to keep that part in mind more than the amount he earned in 1 month. I need you to look for more low risk trades that has the potential for higher gains, higher rewards, and not, I gotta make this amount of trades per day, per week. I got away from that. I did. When I started looking at, hey, I'm only trading when I'm looking at Forex Factory, I'm only trading when there is no high impact or low impact, high impact or medium impact news. That cut down how much I traded in a week. However, that has also cut down the amount of losses, lessons in the market. Hence why when y'all look at the results that I have from like the Forex, the live Forex market analysis, you're seeing that in a month, I'm not losing more than 2 trades. Why? Because I'm only looking for low risk opportunities, high probability trades, ones that are giving a risk to reward of at least bare minimum 1 to 2. So like for the month of October, we didn't really get to trade much because I wasn't available one of these weeks or 2 of these weeks, 2 of these Sundays this month, right? But guess what? 4 and 1. One lesson, and that lesson is only if a person was hard-headed and didn't listen, or if they misunderstood what I was saying. That's the only way a person would have taken a lesson with the analysis that we do on Sundays for the month of October. But notice the number is small. It's 4 wins, 1 lesson. Why? Because there's a whole lot of news that was happening in the month of October. Y'all, it's going to be the same in November because we have elections coming up here in the United States. Japan just had elections. Like, there's a lot going on. Holiday season. So banks are going to be closed. There's bank holidays and stuff. All this stuff is going to be happening in November. So that means mentally, you as a trader should be preparing to not take as many trades as you took January to say September. Everybody got it? I know I'm going, but just keep following me. The next thing we want to think about when it comes to risk management is risk control. Y'all, this forces you to manage risk properly by limiting how much you're willing to lose on each trade while setting reasonable goals for profit. This is where I personally, and plenty of other people who are like me, a lot of them have quit trading, just said, forget it. It's not for me. I'm not willing to lose any more money. I don't want to spend any more money learning the skill. I'm just going to chuck it up as a loss. Those people have quit. Me, on the other hand, I was like, no, man, I know this is for me. I just got to figure this out. Y'all, once I started focusing more on risk to reward, setting or paying attention to how I feel when I'm losing a certain amount. Because now if I'm panicking and it's $100, I'm not there yet. Next time I trade, I need to bring my potential risk down to, like, let's say $75, see how I feel. Remember, y'all, you calculate that through your pips and your lot size, okay? For your stop loss, which we're going to get into in a second. So you need to adjust, right? Y'all ever notice, like, when I'm on the FOREX live market analysis on Sundays, for those of y'all that have not tuned in, it's on YouTube here at 10 p.m. Eastern Standard Time, 9 p.m. Central. That's 7 p.m. Pacific, okay, on Sundays, right here on YouTube. All right, so that I say this a lot. I talk about risk to reward, risk to reward, risk to reward. So I'm going to give you the example, which I was just talking about for October. All right, October 13th. Wait, let me look. Yeah, because that was the previous. Okay, so October 13th, we did the live market analysis, and this was gold and EURCAD. So that's the euro paired with the Canadian dollar, right? So, and if you missed that one, you can go back and check that session out. I want to say that was session, we just did 28, so 27, right? So that was session 27 on this YouTube channel. You can go check it out. But anyway, I was, marking it up and everything. And when I was establishing like the profit areas, I noticed that the buy that the market was saying we were supposed to have for Euro CAD, right? It wasn't yielding a risk to reward of at least 1 to 2. So I'm like, hey, y'all, I mean, if you trade like me, if you're a day trader, hey, if I were you, I would not take this trade for a buy, because not only is not showing a risk to reward, I want to say there was a bank holiday for Canada the following day and everything. I was like, listen, just wait for the right setup. If anything, y'all, if the market doesn't continue to buy, trust me, you'll be able to make more money with the sale. You know what I'm saying? Like, because it just wasn't looking good. Now, here's the thing. If the person listened to me, right, and didn't take the trade, they would have made money because they would have took the sale. They would have saw the setup for the sale, and they would have took the sale. However, if they didn't listen to me, it would have resulted in a loss. Does that make sense, y'all? So remember, for every trade you're considering taking, ask yourself, is the juice worth the squeeze? Before you even take it, is the juice worth the squeeze? Because you already know what you're willing to risk. That should always be established. But is the juice worth the squeeze? Am I potentially going to get a risk to reward of at least 1 to 2 or higher? If this is helping you and it's making sense, I need you to drop the words, it makes sense, Leona. Drop the words, it makes sense, in the chat, in the comments. If you're watching a replay, drop, it makes sense, Leona. Let me know that it's making sense. Remember, y'all, don't do this while you're driving or you're at work and you ain't supposed to be on the computer, okay? You ain't supposed to be on YouTube, okay? So now let's move on to my favorite things to use in the market today. And this is part of our risk management, and that is the stop loss order and the take profit order. So you're not going to hear me say stop loss order, take profit order. I'm not going to say that. I'm just going to say stop loss and TP, okay? So if I say stop loss in TP, so TP1, that means take profit, my profit area, all right? But anyway, we're going to get into stop loss first. So if you're not familiar and you are learning about trading, I need you to write this down. This is another one of those things you need to know as a trader. If you don't know this and you don't utilize this, you're setting yourself up for failure, okay? You're setting yourself up for failure. So a stop loss is simply a tool to automatically close a trade by the broker on your behalf if the market moves against you by a certain amount. This just simply limits your losses, okay? So I want you to think of this like a safety net. So if you were to fall from something high, there's something to catch you, right? Right, that safety net is going to catch you. Now, the beauty of this, using a stop loss, is you establish how much you are comfortable with losing. And this is on any given trade. You adjust that. No one else has to know how much you're willing to lose or whatever. They're not going to know unless you do what? You tell them. It's none of their business, right? If you're at a point right now where you're like, Leona, honestly, I'm not comfortable with losing more than $10. Well, guess what? That means your potential wins may not be more than $30. if you know what I'm saying, or $20 if every one of your risks if every one of your trades has a risk to reward of 1 to 2, you may not stand to gain more than $20. I need you to be aware of that though. If you're fine with that, cool, run it. If you're not, then that means number one, you're gonna need more capital. That's number one. Number two, you're gonna need to work on building up your muscle to withstand seeing your account down more than $10, more than $20, more than $50, more than $100, more than $1,000, so on and so forth. Everybody got it? Okay. So that's stop loss. This is our safety net, y'all. Our safety net. If we're going in for a buy, but price turns around and drops, well, we set our stop loss. So now once price hits it, our broker is going to close us out. And our balance in our broker account is going to reflect that lesson in the market. Now, the opposite is for our take profit order. All right. So when y'all are watching me on Sunday night, I'm saying TP1, TP2, TP3. That means our profit area, take profit. This is a preset level where we as traders will automatically, or where a broker is going to automatically close us out when our desired profit is reached, because we're putting that number, that price point, into our broker account. Okay. So let's say you're participating, or you're anticipating, you're anticipating the price of gold to continue going up after this election next week, right? Okay. So let's say you use historical data, you got technical indicators, some things happening in the news, you got some technical analysts, right? Are saying certain things about gold specifically, any other tools, whatever, to help you establish an area that price has the potential to go. Remember, y'all, with these risks and rewards, you don't always have to be right. Okay. So once price hits that area, because you say, all right, I'm entering the trade, you put the number in your broker account, right? And now when the price goes to that area, your broker is going to close you out in profit, and they're going to update your account balance to reflect the amount you have just won in the market. Everybody got it? So the stop loss and take profit are two tools that we can use to help us to not have to look at the charts all day. We can set, as I say, our parameters and go on about our business. You can go get your hair cut, get your hair done, get your nails done, go shopping, go to work, go work out, whatever. You can do all of that because you have set your parameters and your broker is going to close you out. Okay. Now, here's one more thing that you can use if you're like, hey, let's just say, I'm not going to, let me not get ahead of myself. Let me just say what it is. There's another tool you can use, and that's called the trailing stop loss. If you have not been taking notes, I need you to come back to this and watch the replay, and I need you to take notes, especially if you're new to trading. Okay. There's something called a trailing stop loss, y'all, and I'm wrapping up. Trailing stop loss. You use this to secure profits while the market is in momentum and in your favor. So let's say we're going to use the gold example again. You enter the trade for a buy because data, historical data tell you, technical indicators, news, whatever. All of this points to the potential of the rising price of gold. So you can activate a trailing stop loss at a specific price point once you're in profit. You do that through your broker. So with most established forex brokers, you can also include a set number of pips that you want your stop loss to trail as the momentum continues in your favor. Example. So let's say I'm expecting gold to go up and I'm like, but it's already at an all-time high. Me personally, I would say if you're going to do that, then you may want to keep a tight trailing stop loss, probably 10 pips. So that means once price is in profit, let's say 10 pips, then your stop loss is going to move from where it's at to your entry point. Once it moves another 10 pips, which is 20 pips in profit, once it moves 20 pips in profit, now your previous stop loss, that line is now going to move and put you 10 pips in profit. Now, if price were to drop down because it made another all-time high and it drops down, you are now securing 10 pips of profit and the broker is updating your account. Okay, y'all, this is a great tool to use for day traders and swing traders so that you don't have to look at the charts to find an area to secure partial profits, right? You don't have to worry about that. In essence, the trailing stop loss honestly does that for you. Okay, so if you use these tools, right, let me know if you're going to use any of these tools because you have not, because you're new to trading or you've never heard of the trailing stop loss or not understood how it's used. Then if you're going to use it, drop that in the chat or the comments. Okay, drop that in there as well. And if you're comfortable with sharing, tell us why you're going to use them. All right, tell us why you're going to use them. All right, last few things and then we're done because I have to go. I have another meeting that I'm supposed to be out right now, actually. So position sizing, that's our lot size, y'all. Position sizing is used to manage risk by controlling how much of your account is put into each trade. Now, remember, y'all, I talked about this in part 1 of this series using the term lot size. If you have not watched that, go back, watch the replay, okay? Seriously, if you missed it, I need you to go back and watch it. All right, one trick, I mentioned this already, that I've used on myself and continue to do today is to calculate how much I could lose on a trade first with the lot size that my growth chart, my FOREX growth chart is suggesting based on my trading balance. Y'all, I can calculate what I stand to lose by knowing how many pips and also knowing how many pips and then the lot size. Okay, so what this does is remind me to think about like my risk tolerance right now. So I keep talking about this, but I want to know, okay, if am I comfortable with losing $50 right now, $100, $1,000, $10,000? Like, where am I at right now? If I say, man, this lot size is saying I have the potential to lose 10,000, yeah, I stand to gain 30,000, but I don't know, I'm not ready for that. Then guess what? I can lower my lot size to the number that I'm comfortable with. Okay, so this will also help us to build up our risk tolerance at a slower, or I would say a steady pace. It may be slower for some, but it definitely can help you build up that tolerance at a steady pace. So however, your loss amount would be much lower than if you focus on that. Your loss amount would be much higher if you focused on profit first. But if you focus on how much you stand to lose first, then how much you lose, how many lessons you have in the market, all of that starts to decrease. Okay? Yeah, I even discussed how to calculate this. I already said that in part 1. So please, if you missed it, go back. You need to go back and watch it, y'all, because I'm not going to break it down this time, okay? Because I'm already late, okay? So for those of you that did watch that part, does that help you with clearly establishing your risk before entering a trade? Does it help you with establishing your risk before entering a trade? Who's going to use this trick? Who's going to use this trick during the next trading week? Right? Let me know in the chat or in the comments, whichever one. Okay? So last part, and then we're going to wrap. And that is, I'm going to give y'all a tip. And this is something that I wish I would have gotten in the beginning, but whatever. I'm giving it to y'all now. I recommend that beginners risk no more than 1% of their total trading balance per trade to protect their account. And I recommend that on any given day, you do not risk more than 3%. So let's say, as a matter of fact, I'm gonna say 2%. I'm one of those people. If I lose one trade, like my first trade, if I lose my first trade in a day, I'm not taking another trade. It's a psychological thing for me. I'm like, you know what? I'll come back to the market tomorrow. I'll mark up and stuff, but I'm closing my broker account. Why? Because I don't want to tempt myself. I'll mark up some stuff, and then I'll go on about my day, and I'll come back to the market the next day. That's me. That has helped me to minimize losses. So I need you, as part of your risk management plan, to make sure that you put in there, especially as a beginner, or if you have not seen consistent success, you need to go back to that too. Do not risk more than 1% of your total trading balance on any given trade. And I will go so far as to say, do not risk more than 2% in a day. Everybody got it? Now, here's the thing. I'm sharing this because I wasn't taught this in the beginning. And I blew countless accounts, but couldn't figure out why. And at the time, I was being taught, y'all, to risk up to 3% of my trading account balance. You know what I'm saying? This is as a beginner. People were teaching me this. Not once did anyone that was teaching me say, no, you need to stick to 1% until you've grown your account to a certain percentage, or until, you know, you meet certain criteria as a trader. Like, this was one of the many things I learned later that was not sound advice for me as a beginner. So now, before anybody say anything, y'all, I'm not blaming my losses, blown accounts and stuff on the people that taught me. I'm not blaming it on them. I'm just sharing with you all that if I would have known that and understood risk management better, that would have saved me money, and it would have saved me a lot of the trading trauma that I have been working through for the past 4 years, right? Okay, so I cannot stress this enough. Before, you know, we get to moving on and whatnot, trading is an individual sport, y'all. So every win or loss or a lesson, as I say, in the market is solely on you. Use all the information, the wins and the lessons, use them to collect data. Make adjustments that you see fit and come back into the market when you are ready. All right, got it? Good. So we're going to stop there, y'all, because I have to go, like I said. And we're going to complete our final part of this series next week on November 7th at 1 p.m. Eastern, 12 p.m. Central, 10 a.m. Pacific, okay? We're going to get into emotional control and time-efficient strategies for busy traders. So I'm going to give y'all your homework assignment. Normally, I would do a Q&A, but I really have to go. And plus, I'm taking it y'all at work because I'm not seeing the comments coming through. So I'm going to give y'all your homework assignment, and then I got to roll, okay? So let's get to it. So homework assignment. I need you all to continue to practice your technical analysis, okay? Continue practicing identifying the trend, support and resistance levels, using that demo account, trading view. Make sure you're looking at support and resistance on the 4-hour time frame, okay? Make sure you're sticking with the major currency pair that you selected in part 1, okay? Number 2, continue applying the moving average and the RSI separately as well as together to see when the prime opportunities are presented in the market for you to trade. Risk management. This is what I need y'all to get. Number 1, I need you to establish your risk tolerance. How much money are you comfortable with losing on any given day? I need you to write that down. Be honest with yourself. This is not the time to embellish and just flat out lie to yourself, y'all. This is a time where you have to be honest with yourself, okay? The number you say will only be known by you unless you tell somebody. So there's no judgment here, y'all. Your number is your number. That's number 1. I need you to write that down, though. Put the date and then sign it. That's a contract you're telling to yourself. I am not risking more than this amount of money until my risk tolerance grows, okay? Number 2, I need you to practice identifying trades that yield a risk to reward of 1 to 2 or higher, okay? This is for every single trade, every single markup that you do. I got it. Scalpers, y'all don't do that, but I'm talking about day traders and swing traders. This is for us. I need you to practice identifying that risk reward of 1 to 2, okay? Last thing, y'all, is to consistently set a stop loss and a take profit. When you are entering a trading or demo account, do not close out your broker account without setting a stop loss and a take profit. Why? Because you want to get comfortable with the risk and also the risk to reward ratio that we discussed. This portion is only for those of you that are already trading, of course. Seriously, y'all, please don't skip this. Don't skip a time of activating your take profit or stop loss. This is going to help you with managing your emotions as well, okay? Plus, it's going to help keep your money in your broker account. It's going to help it grow, okay? That's it. So remember, y'all, don't forget to use these 3 things to create your risk management plan. I know there's more that I could add, but, you know, time and everything, this is a solid starting point, okay? So in addition, I need you to continue taking notes in your journal on how your trades perform and bring your results. And if you have any questions, bring those to the next live stream. Remember, y'all, I'm going to be live on November 7th at 1 p.m. Eastern, 12 p.m. Central, 10 a.m. Pacific, okay? So that's all I have, y'all, because I really have to go. Remember, y'all, you got your homework, so now go out here, get it done. Do the work. Put what you have learned today into practice, and I am going to end this session with my favorite quote, and that is from the legend. His name is Arthur Ashe, and he says, to start where you are, use what you have, and do what you can. Y'all be safe out here for Halloween. Have a great weekend, and I will see y'all next week. Happy trading, y'all. Bye, y'all.